Hey everyone, in this video I'm going to go through how to construct the cash flow statements for a firm by using an extended example. I'll be constructing the cash flows from operations, investing and financing, and I'm going to be doing this by using the firm's balance sheet, its income statement and the notes to those financial statements. So in our problem scenario here, effectively what we have is a balance sheet, we have an income statement, and we have various notes to the financial statements as well. And effectively, we will need to use this input in order for us to generate a cash flow statement. And the way that we effectively do this is we construct T accounts for many of these balance sheet items, use inputs from the income statement and the notes, and then we extract what cash the firm might be spending through each of these T accounts. Now, it turns out that many of these T accounts end up being interlinked. However, we will need to go through them nevertheless. It is also worth noting that some of the expenses here already tell us effectively what some of the cash flows are, similarly with some of the income. And this enables us to work out some very easy to get cash flows. Finally, some of these expenses are non-cash in nature or are mixed cash and non-cash. So for example, other expenses can include cash and non-cash items, and we'll need to tease out what is cash flow related from that. Nevertheless, it becomes relatively easy after you've done it a few times. And going through exercises like this is a good way to become acclimated to constructing cash flow statements. So with this in mind, let's start going through the T accounts so we can start constructing our cash flow statement. So the first thing that we might want to start off with is, for example, accounts receivable and allowance for doubtful debts. This is a reasonably good place to start because it enables us to get things such as the cash flows that we are getting from customers, which is going to be a core source of cash flow when we're trying to analyze our cash flow statement. So that's what we're going to start off with. So what we might do is we need to start off with accounts receivable, and we need to also construct the allowance for doubtful debts. Now, it turns out that these two are in fact quite interlinked. They're quite interlinked because allowance for doubtful debts can have implications for accounts receivable. So say we're starting off with accounts receivable here. Let's have a think about what types of things might occur. And then when we're looking at this later on, we're also going to need to take into account some other T accounts. So in terms of the accounts receivable, we can start with our opening balance and our closing balance. The opening balance here is clearly 128, and the closing balance is 145. We can just read that off or straight off from the balance sheet here. So 128 and 145, just reading it straight off. So that's what we can start with. What we then also need to consider is what things can increase or decrease accounts receivable. So things that can increase accounts receivable include credit sales. Things that decrease accounts receivable are really twofold. One, we can get cash in from our customers, and two, we might write off some of it, which will manifest in doubtful debts. Now, to get the amount that we've written off, we're going to need to turn our minds to the allowance for doubtful debts in order to fill this in. Nevertheless, we can start by filling in part of what we have here. So on the debit side of this, we're going to have sales. Now, the sales here are 1520 rather. Now, in order to see where we're getting this from, we need to go to the income statement. Now, in the income statement, you can see sales up here, 1520, and we're just taking this through to our T account. On the credit side, we, as I've indicated, have two potential things. We have things that are written off, and we also have cash receipts. And we're going to need to work out the numbers for these. Now, we're going to need to get our amounts written off so that we can back out the cash receipts. So to get the amounts written off, let's turn our attention to the allowance for doubtful debts and then go back to the accounts receivable. So if we start going through to the allowance for doubtful debts, we can now look at the T account for it. So the opening balance for the allowance for doubtful debts is 12, and the closing balance ends up being 16. Now, in terms of things that increase our allowance for doubtful debts, that's effectively going to be things to do with bad debts expense, i.e. whenever you have sold something, you'll get debit bad debts expense, credit allowance for doubtful debts. The other things that we need to consider here are potentially things being written off. And when you write things off, that's going to have AR implications and ADD implications. So let's start off with the bad debts expense, which is arising whenever we're selling these underlying items. So to see where that's coming from, if we look at the income statement here, we'll see that bad debts expense is 15. So on our credit side here, we can put 15, and we'll just note that that is associated with bad debts expense. So that's what we have to begin with. Now, what we'll also need to do after we've got this is we're going to end up needing to go to, well, what's been written off. Now, the writing off here is what's going to be on our debit side. So if we sum up our credit column, this ultimately sums to 27. So what this means is we need to get our debit column also balancing. So to get our debit column balancing, it will be 16. So I'll call this write-offs. And that will ultimately end up being 11 here as our amounts written off. Now we can take this amount written off and bring this through up to our accounts receivable. So let's bring this into our accounts receivable now. So the amount written off is then 11. So we can then start balancing things together. So on our debit side of accounts receivable, we have 1645 as the total sum. Our credits then also need to sum up to 1645. So what this implies is you need to get cash receipts that cause this to balance. So when you do the math on this, 1645 minus 145 minus 11, what you'll end up with is 1492 as your cash receipts. So that's going to be one of our first portions of our cash flow statement here, 1492 in terms of cash receipts. Now, naturally, this would go into the cash flow from operations. So let's keep this in mind, and then we'll refer back to this when we construct the final cash flow statement. Now we can next go down to say accounts payable and inventory. Now these two are inherently interlinked because if we make credit purchases, then that's going to result in accounts payable. So the two need to be done to some extent hand in hand. So let's go through constructing these T accounts. So we can start off by constructing an inventory T account. As before, this is often going to be interlinked to accounts payable. But let's start off with the inventory T account. So our opening balance for inventory is 190 and the closing balance is 175. Now you can get this by just reading it off the balance sheet. This is right over here with 190 is our inventory opening balance, 175 as our inventory closing balance. So we then need to think through what things might increase or what things might decrease our inventory. Well, things that increase the inventory are the purchases. Things that decrease the inventory are the sales. And here we can get our sales from the cost of goods sold. So on our credit side here, we'll have COGS. So the cost of goods sold here is 1,110. So let's just note COGS here as 1110. Now to see where this is coming from, we can go up to our income statement and COGS is right below our sales. So what this means is the purchases need to be such that our debits and our credits ultimately balance. So over here on our right hand side, our summation here is 1285. So what this means is our purchases must be such that we get 1285. So when we do this, we can end up with our purchases. So our purchases here will be 1095. Now we're going to need to store this in mind because this is then going to filter through to our accounts payable. This becomes important because it will then enable us to infer what cash is associated with accounts payable. So we're going to need to refer to this later. So let's go down to our accounts payable next. So in accounts payable, we can again read off our opening balance and our closing balance. So the opening balance for it is 51 and the closing balance for it is 87. Again, we're just reading this off the balance sheet here. So far, nothing particularly complicated. Now, in terms of the things that increase accounts payable, things that increase accounts payable are purchases of inventory, which we are assuming to be on credit. Things that decrease accounts payable are cash payments to our suppliers. So on our credit side here, let's put in our purchases of inventory, which, as I discussed before, is 1,095. So therefore, the total summation of our credits is going to be 1146. So we then need our debit column to also sum up to 1146. what that implies is we will have paid some cash to our suppliers. So to get these to balance, we have 1145, or 1146 rather, minus 87, and that means we paid 1,059 in cash to our suppliers. So that is how we get another portion of our cash flow statement. So we're going to need to bear this in mind, and this will filter through into our cash flow from operations. So it obviously is going to become important for us in a second. So we can then go through to additional portions of the balance sheets here. So the next thing that we're going to want to look at is depreciation. Now, interestingly, depreciation is not a cash flow item, i.e., you will not see depreciation on your cash flow for operations or any other cash flow in our cash flow statements. Rather, depreciation is relevant only insofar as it enables us to tease out other cash flows. Here, it is actually relevant for us to be able to dissect accrued expenses and to dissect which other expenses actually manifest in cashes for us. So we do need to go through the depreciation tier accounts, but we're only going through them so that we can work out other cash flows. And we can then see what our depreciation ultimately looks like. So let's start off with the depreciation for the buildings. So if we're looking through the depreciation for the buildings, we can again start with our opening balances and our closing balance. So the building depreciation opening balance is 81 and the closing balance is 75. We can see this because it is a contra account in the asset. So it's basically a contra asset. So we then need to think about what things are going to increase or decrease accrued expenses for buildings. Well, accrued expenses for buildings, or accrued depreciation, sorry, for buildings, what that will increase with is if we have a depreciation expense, i.e. it goes debit depreciation expense, credit accrued depreciation. The depreciation or accrued depreciation will decrease if we have a sale. So let's see whether there was a sale here. Well, it turns out we're actually told there was a sale of a building. You were told in the notes that a building with $43,000 of accumulated depreciation was sold. So what this means is we can get rid of $43,000 on the debit side. So we go debit, and this is sale. So we'll note it as being related to the sale. And it'll be 43. So therefore, our debit column sums up to 118. So to get our credit column to balance, we'll have a depreciation expense of 118 minus 81. So that will give us a 37 depreciation expense. So that's what we have for buildings. Now, notably, none of these are actually cash flows, but this depreciation expense is going to be relevant later on. We can next look at the depreciation in relation to equipment. So for our equipment here, we have an opening balance of 149 and a closing balance of 214. So we're going to need to put that into our tier count. Now, when we're having this depreciation, we again have it having function much the same way as buildings, by which I mean that the accumulated depreciation for equipment goes up if you have depreciation expenses and goes down if you have something like a sale. Now here it turns out that we do not have a sale. We are not told anything about a sale of equipment in the notes. So therefore our debit column will sum up to 214. So what this means in our credit column is we must have had a depreciation expense for our equipment. The amount of the depreciation expense will be 214 minus 149. So that means our depreciation expense will be 65. Again, that 65 here is not a cash flow. However, it is relevant when we're working out other cash flows. So we will need to keep that in mind. So that's what we've got for our depreciation tier counts. Notably, however, these are not cash flows, but we will use them. So to use them, we're going to need to look at accrued expenses. So accrued expenses basically pertains to other expenses that we've accrued potentially period to period, some of which will pay off, some of which will accrue. The way that these would be accrued is by virtue of the other expenses within our income statement. So if we look at our accrued expenses here, what we can do is we can look at where these things are coming from. So the accrued expenses start at 11 and they end at 27. We can see this just by reading it off our balance sheet. However, we then need to look at the other expenses portion of our income statement. So other expenses in our income statement ultimately totals 198 here. So we then need to work out which portion of this is not due to depreciation. Well, we already noted there was depreciation of 37 and 65. This was just in relation to the building and in relation to the equipment. So we have depreciation of 102. So therefore, the amount of other expenses that might go into the accrued expenses portion of our T account is then 198 minus 102, which is equal to 96. So therefore, if we go over to our accrued expenses T account, we have our opening balance and our closing balance, like I mentioned. Our expenses are 96, and therefore our credits all sum up to 107. So what this means is the cash amount that we have ultimately paid in relation to accrued expenses is 107 minus 27, which is equal to 80. So this then will filter through into our T account, into our cash flow statements rather. So we'll need to keep this cash amount in mind for later on. So that's our accrued expenses. That also illustrates to you why the depreciation expenses are relevant, notwithstanding them not being actually cash flows themselves. So that's another cash flow we'll need to bear in mind. We can then also look at income tax. Now, the income tax payable here, again, is in our balance sheet. We start off with an opening balance and a closing balance at the end. So our opening balance here in terms of income tax payable is 23. Our closing balance is 15. Now, we need to think about when will it increase and when will it decrease. Well, the income tax payable increases when we have an income tax expense, but it decreases when we pay off some of that income tax. So let's start constructing it. Starts at 23 and then it ends at 15. So what we can see here is we can start looking at our income tax expense, and that would appear here on the credit side of our T account. The way this would work is we'd have debit income tax expense, credit income tax payable. So with our income tax expense here, what we can see is this ultimately ends up being 67. So what we do is we put 67 on the credit side of our T account. 67 pertaining to income tax expense. So therefore our credit side all sums up to 90. Our debit side then needs to also sum up to 90. What this implies is we had a cash payment of 75. That is 90 minus 15. So we can then keep this in mind as a cash flow that will arise later on. This also is going to be a cash flow from operations, which we will need to refer back to when we get through to finalizing the cash flow statement. We can now start to change tack and look at land and buildings. So if we're looking at land and buildings, these are notably part of the investment cash flows. So they will not appear directly anyway in our cash flow from operations. Rather, they're going to appear in the investment cash flows. So let's go through land and buildings and see what cash we either got from sales or spent on land and buildings. Now, these notably are slightly complex. The way that I will generally start with these is I'll start with the revaluation surplus. The reason I'll start by constructing the revaluation surplus is this then enables us to work out some parts of the land and the buildings. So the revaluation surplus is going to be useful for us working out what, if anything, has happened to the value of land and buildings. So I'll start off with that, and then we'll go through to the land and buildings itself. So it is actually useful to start with this. So let's think about our revaluation surplus. The revaluation surplus has an opening balance here of 17 and a closing balance of 32. So we can enter that in relatively easily. And then we need to think about what things might increase or decrease the revaluation surplus. Well, things that increase revaluation surplus are going to be things such as, well, obviously a revaluation. Things that decrease revaluation surplus are going to be things like a bonus issue declared out of it. Dividends would not normally be decreasing the revaluation surplus, because those are ordinarily paid out of retained profits. So the only debit that we might have potentially pertains to a bonus issue. So let's hunt down to see if there was one. Well, it turns out that in the notes, there was in fact a bonus issue. So the bonus issue here was 15,000. So we're going to be able to record that 15,000 bonus issue on the debit side of our revaluation surplus. So we have the bonus issue of 15K. So therefore, the debit side of the revaluation surplus sums up to 47. We'll also need our credit side to sum up to 47. Now, notably, the only thing that will increase revaluation surplus is if you revalue something upwards. Now, here we can hunt down what revaluation might have occurred. You were told in the notes specifically that land was revalued up during the year. However, because the notes are silent on any other revaluation, it implies that the land was the only thing that had a revaluation here. So therefore, we can basically work out the revaluation of the land. The revaluation of the land will be 40 minus 17, which will equal 30. So we can then enter this in. Now, notably so far, we have no cash flows. However, the revaluation of the land is going to be important, i.e. necessary, for us to construct the land T account. So let's move through to the land T account and start trying to construct this in addition to the buildings T account. So say we start off with land. Well, what we can do is we can think about some things in relation to land. I'm going to first enter the opening balance and the closing balance. So the opening balance for land is 149 and the closing balance for land is 172. So let's enter those in first. The next question is then, well, what other things might appear in our land T account? Well, in a land T account, it will go up if there's an upward revaluation. So here we have an upward revaluation of 30, as I just mentioned. What other things could cause it to go up? Well, a purchase could cause it to go up, and we'll need to work out if there was in fact a purchase, and if so, for how much. In terms of the things that can cause land to go down, it can go down if there's a sale of land. So here we are in fact told that there was a sale. So if we look over here at the notes, you're told a parcel of land with original cost of 60K was disposed of. So that tells you that here there's going to be a credit to 60 to our land. So we get 60 here from the sale of land. Now, notably, we have not yet worked out how much cash we got, but we do know that on the books, it was recorded at 60. What this means is we can then sum up our credit side. So the total of our credit side is 232. Our debits obviously then also need to sum up to 232. So when you do the math here, 232 minus 149 minus 30 means we must have spent 53 on a purchase. So that then is going to go through into our cash flows. So we've got a 53 expenditure on buying the land. Now, what about the cash on the sale of land? I mentioned just prior that we sold a parcel of land. We sold land worth 60 on our books. However, that does not mean that we got 60 from the sale. So in order to construct this, what we need to think about is the journal entries. So for our journal entries, what we have here is credit to land of 60K. This arises because we sold land worth 60K. Now, what else will we have? Well, when we're selling land, we can either get like a gain on disposal or a loss on disposal. So let's hunt down whether we got a gain or a loss. So if we go back up to the income statement here, what you will notice is that there was a loss on the sale of land of 18. You are explicitly told this in the income statement. So that means that if we're looking at constructing the journal entries for our land sale, you get debit loss on disposal of the land. This means that the difference between the two must have been how much cash you got. Therefore, you must have gotten a credit to your cash, a debit, to your cash of 42. So that implies that we have a cash inflow of 42 from the sale of the land. We can now go through to the buildings. Now, in relation to the buildings here, Similar type of process, albeit less complicated than with the land, because with our building here, we don't have the revaluation we need to deal with. So let's start off with our opening balance and our closing balance. For our building, the opening balance is 225, closing balance is 186. So that's what we can start off with here. So opening balance 225, closing balance is 186. Now, what else are you told about this? Well, you were told that a building worth 89 is sold. So to see where that is coming from, you were explicitly told that right in the first note. So we know then that there will be a credit to buildings of 89, i.e. what would have happened here is you will have other debits, which will include cash that we'll get to, but you also have you have here the sale of 89, which is what we'll just deal with right now. So when you sum up the credit side, you get 275. So this means that there is something missing on our debit side. So on our debit side, the thing that is missing is worth 50. And the only thing that would arise here is a purchase of a building. So this is going to be a purchase that will filter through to our cash flow for investment. So we'll need to keep that 50 in mind later on. Now, you'll notice again that I mentioned that we sold the building. However, I have not so far mentioned how much cash we got from the sale. We sold buildings that were worth 89K on our books, but I haven't mentioned what our cash is. So let's work out how much cash we get from this sale. So in terms of working out how much cash we have, let's start off by saying, well, we sold buildings that were 89 on our books. Now, let's also have a look at what else we know about it. So if we go back up to our notes here, we were told that we sold buildings that had 43K in accumulated depreciation. That means that we're going to get a debit of 43K to accumulated depreciation. We can also look at our income statement. In the income statement, we were told there was a gain on the sale of buildings of 31K. That means you'll get credit gain on sale of 31,000. So we can start to put together our journal entries. So our journal entries, initially we have the credit buildings. We have a credit gain on sale of 31. This is from the income statement. We have a debit to our accumulated depreciation of 43. You're told this in the notes. This therefore implies that the cash that you got is what is necessary to make your debits and your credits balance. So here, therefore, your cash must have been 77. So we're going to keep this in mind for the investments cash flows. So that's what we have from the sale of buildings. We can then next look at the investments portion of the balance sheet. The investments portion might be, for example, the purchase of cash and marketable securities. And by cash here, I mean cash in terms of it being an investment item, i.e. like government T-bills. So in terms of investments, we can start by looking at, again, our opening balance and closing balance. So our opening balance is, for investments, 169, closing balance is 214. So this tells you that there was a change in between. Now, when it comes to the investments, there's not really much that can really have gone here. We could theoretically have a write-down if there's marking to market, but you're not told anything about marking to market. So it just means that we're likely to have some increase in investments. And you can see that because our closing balance is above our opening balance. So opening balance was 169. Closing balance is 214. So what this implies is we must have had a debit in the form of a purchase of investments. So the purchase, therefore, must have been 214 minus 169. So our purchase, therefore, must have been 45. And that, again, is relatively straightforward as far as these tier counts go. So that's what we have so far for our investment-related things. We now start moving on to some of the financing-related cash flows. So we can start off with the mortgage debenture. It's as good a place to start as any. And it turns out there's not really much to put in here. And this will go into our financing cash flows. So a mortgage debenture is basically a debt security that pertains to a mortgage. So a debenture is a borrowing. A mortgage is a mortgage type structure, which effectively implies that is a debt or a borrowing where there's collateral involved over a particular asset. So for example, that collateral could be over a home, or it could be over a piece of real property, or it could be over another form of asset, like a chattel. It could be over, say, a car. It's basically just something where there's collateral involved, and a debenture is a borrowing. So here what is happening is the firm has a borrowing that takes the form of a mortgage. So a mortgage debenture, it starts off here. If we have a look at our balance sheet, the mortgage debenture starts off at 0, ends at 75. That implies the firm went out and it borrowed $75. So that's relatively straightforward in reality. What that basically just means is we got $75 as our cash flow. So I'll just put this as 75 as borrowing. And that's going to be $75 in the form of cash. So that's what we'll start off with as our mortgage debenture. So we can then look at other debt instruments in very much the same way. So let's go through to the other portions of the financing related activities that might arise. So the next one we might look at is, say, share capital. Of course, we will need to look at whether there was an issuance of shares that netted us cash. So when you have share capital increases if you do a bonus issue or a share issue. It decreases if you do a share repurchase. Now here we know there was no share repurchase. There's nothing in the notes about a repurchase. There's nothing that would imply any form of share repurchase. However, we do know that there was a bonus issue worth 15. We know that from the notes down here where it says there is a bonus issue declared out of the revaluation surplus. So let's start filling in the T account for share capital. The opening balance is 420 and the closing balance is 491. You can get this simply by reading it off the balance sheet here. So share capital down here starts off at 420, ends at 491, relatively straightforward so far. What we then need to do is we need to look at, well, what things are going to be credits that are going to influence our share capital amount? Well, we know there was a bonus issue worth 15. Now, the bonus issue is not a cash flow. However, it is important for us so that we can work out what the cash flow is. So the only other potential thing that could arise here is a share issuance. The share issuance then would be 491 minus 420 minus 15, i.e. it is what is necessary for us to balance up the credit side of our T account here. So the share issue then must have been 56. And that is going to be a cash inflow to us from effectively issuing shares. So that's our share capital. Let's then look at the short-term loan. Now the short-term loan, again, there isn't very much that's going on here. There's a change over time, of course. So our short-term loan goes from, in this case, 20 to 9. That implies we must have paid off some of the short-term loan, or at least on net. So even if we went out and borrowed some more money, the net impact here is we paid off some of it. So the opening balance for the short-term loan, 20, closing balance is 9. That implies we must have paid off some of it. The payment of 11 to our short-term loan here. So that's what we can start off with our short-term loan. Now that's not the only type of debt. Obviously we have the mortgage, but we also have bonds. So we can fill in whether there was any cash flow associated with bonds. So again, we're focusing primarily here on the net cash flow. So in relation to the bonds start off at 259, they end at 109. What that implies is we probably paid 150 in cash in terms of retiring our bonds. So let's just fill this in formally. Starts off at 259, ends at 109, which means there would have been a payment of 150. So that, of course, is going to go into our cash flow from financing as well. So again, we're going to need to keep that one in mind. However, what you'll see so far is we've not done all of the owner's equity accounts. We need to consider the other owner's equity accounts. Now, when you think through what things can affect owner's equity accounts, one thing that we haven't considered so far is whether there was a dividend payment. And we'll need to go through the other owner's equity accounts to try to sort out if there was a dividend payment. And this is going to involve us looking at the general reserve and the retained earnings. We need to look at the retained earnings because dividends will be paid out of retained earnings. We need to look at general reserve because one can sometimes transfer money from retained earnings into general reserve. So we need to see if there was a transaction there to work out if that influenced retained earnings, which will then tell us whether there is an influence on dividends. So let's start going through constructing these. So we can start off with general reserve. So the general reserve started at 29 and it ended in 78. Now, a general reserve can increase if there's a transfer from retained profits. It would decrease if you do something like a bonus issue out of it. But here the bonus issue was done out of revaluation surplus. So there's nothing of that nature that would be relevant here. So filling in our tier count, opening balance 29, closing balance 78. What this implies, therefore, is there must have been a credit that would cause these to balance. So the credit, therefore, needs to be 49 so that we can get the debit side to balance with the credit side. And the only way that we get a credit here is if there were a transfer from retained profits. Now, we'll need to keep this in mind when we fill out the retained profits tier count. So let's go through and do the retained profits tier count now. So what you'll see here is opening balance and closing balance. So opening balance is 292, closing balance is 330. So we can fill that in to begin with. And what you'll notice is that it's increased. So if we think about what things cause it to increase and decrease, well, the things that cause it to increase are going to be, for example, things such as profits. So profits that we get in over the course of the year will increase our retained profits. So let's hunt down what happened there. So here we had a profit of 114. So we can just feed this into our retained profits tier count. So therefore we've got 114 from the profits. Now in terms of other things that would affect the retained profits account, there's really two that are presently relevant. One, a transfer to general reserve, and two, a dividend that might have been paid. So the total sum of our credit side here is 406. So what we know is there was a transfer to general reserve of 49. Now, in order for our debits to sum up and balance with our credits, we therefore need 406 minus 330 minus 49, and that will tell us what dividends were paid. So when you do that math, it means that dividends of 27 must have been paid. Now, we're going to assume that these were actually paid because the firm would need to pay its dividends by the end of the financial year if it has declared dividends. So we have a payment here of 27 that is going to feed through into our cash flow statement. So far we have our tier accounts for all of the relevant accounts that we have for our balance sheet and associated with it the income statement. What we can then do is we can start through with the income statements and the cash flows in just 1 second. Now, one thing I do want to note here is in relation to dividends. Now, I mentioned those dividends must have been paid for cash. It's worth emphasizing that with these dividends, what will happen is the firm to begin with will go debit dividends payable, debit retained profits, credit dividends payable when it declares the dividends. When it ultimately pays the dividends then, it will be debit dividends payable, credit cash. Now, during the year, the dividends will be paid for cash because they'll need to have been paid by the end of the financial year here. So hence why we've got a credit to cash of 27 associated with those dividends. Okay, so far we have all of our relevant tier accounts. Let's go through and construct our cash flow statements. So let's start off with the cash flow from operations. Now, I won't belabor precisely where these numbers are coming from because we have already covered them, but I will discuss briefly which tier accounts these are related to. So we have receipts from customers, which is effectively coming from our accounts payable. We have receipts of dividends. Now, you'll notice in the income statement that the firm received 5K in dividends. So let's just go back briefly to the income statement and see where that is. So in the income statement, what do we have here? Well, in the income statement, you'll see that there was a receipt of dividends of 5K. You'll also notice in this income statement that there were some other expenses. So 9K in the form of insurance, 25K in the form of interest. So we'll also need to incorporate those. So going back to our cash flow from operations, what we can see here is we had a 5K earning from receipts from dividends. It is important to note that dividends, when you receive them, are an operating cash flow, but when you pay them, they're a financing cash flow. So here we have received 5K in dividends. Now we paid 159 to suppliers. That was from the accounts payable T account. The insurance and interest, I'm just reading these directly off the income statement, the 9 and the 25. The other expenses paid was coming from our accrued expenses T account, and the income tax paid was coming from the tax payable T account. Now, when you sum all of these numbers together, you get a net cash from operating activities of 249. We can also think about the net cash from investing. So when it comes down to investing, that generally involves things such as property, plant, and equipment. So here we had sales of land and purchases of land and the like. So we worked out that there were proceeds from the sale of land and buildings of 42 and 77 respectively. We also worked out that the firm purchased land and buildings, again coming from our land and buildings T accounts, of 53 and 50 respectively. And then from our investments T account, we also had a purchase of 45 from investments. So the total net cash flow from investing activities is a $29 outflow. Now let's look at financing. Now with the financing, again, we went through many of these. So we got in 75 from issuing a mortgage debenture. We issued 56 worth of shares, which is a cash inflow. However, we paid off the short-term loan and paid off quite a bit of our bonds. We also paid out dividends and paid out 27 worth of dividends. So therefore, our net cash used in financing is a $57 outflow. Now, when you sum all of these together, you can get our net cash increase. So our net cash increase over the period was 163. This notably is going to be equal to the change in cash from the opening balance to the closing balance of the cash amount in the balance sheet. You can cross-validate your results by ensuring that that is the case. In any case, that's how you would go through constructing your cash flow statement and how you'd go about finding the cash flow from operations, investing and financing in this extended example. So I very much hope that this has given you an idea about how you would construct cash flow statements within the context of an extended example. I hope this video has been very useful to you, and I also hope that I will see you for future videos as well. And all the best with your future studying. Bye.